Hello, traders. Gary Wagner here. Just about 1 o'clock in Honolulu, 7 o'clock in New York. It is Thursday, 21st day of October, 2021, and this is the daily report for gold and silver. A small sell-off in silver, a fractional decline in gold pricing today as yields once again went up and the thought of inflationary pressures dissipated just a little bit from yesterday. We'll talk about that in our opening letter and talk about key levels of support and resistance during the show. Gold futures today had fractional declines, currently down 0.07% or $1.20, with the most active December contract currently fixed at $1,783.70. We have spot gold trading just about $1 higher, $1,782.60. But really what has been tempering any kind of upside swing in gold has been today's rise in the dollar index. Dollar index up approximately 0.25%, 0.26%, and fixed at 93.78. Silver had more than a fractional decline. I will label this as a moderate decline, giving up about 21.5 cents or 0.88%. December contract is currently fixed at $24.23. But we must note that it had substantial rises over the last couple of trading days. This first chart that we are looking at is the same daily chart that we talked about yesterday. And in that chart, we expressed the compression triangle, which is really a series of lower highs and higher lows. We talked about the fact that it is coming to the apex, and if it breaks through that apex, that would be at around $1,800. We talked about the marks that it would look to hit. The first one coming in at about 1,810. And then, of course, the brass ring right now is the high that came in back at the end of August at just about $1,836. However, I have added two other studies, a 50-day moving average in green and a 21-day moving average in black. You can see that a couple of days ago, we definitely saw gold rise above its 21-day. Yesterday, it rose and closed above the 50-day. And although gold prices closed fractionally lower today, it remains above its 50-day moving average. And that is some hopeful sign of a return to stability in terms of price structure. We have converted our candlestick chart into a Henkin Ashi. The key difference between this and the candlestick chart is how the open is fixed. On a candlestick chart, like a bar chart, the open is the true opening price, whereas in this type of chart, the open is simply fixed upon the midpoint of the prior candle. Now, it does not have a lower wick. It's a small-bodied candle, but after the pivotal candle that we saw occur 2 days ago in trading, and then a small green candle, although it had tails on both the upper and lower end of the real body. Today, it has that absence of a lower wick, and that is a positive sign because what it says is that at no point during the trading session did prices go to or below the midpoint of yesterday's candle. The last chart that I want to look at for gold today is a three-line break chart. We have been using this lately. We've talked about various support and resistance levels. We are much closer to resistance than we are to our first level of minor support. That comes in at 1748, below it 1719, and then 1680, with 1800 really being the brass ring we'd like to see gold be able to take out on a closing basis. However, as we have seen viewing this type of chart, the three-line break chart, we are still looking at a forecast of lower pricing, and that is this magenta bar right here. Lastly, I do want to take a quick look at silver. It did decline by almost 22 cents today, but you can see I have put a number up. This is $24.27. It closed just below that. That is the 61.8% fib retracement. As you know, it's of a longer data set, but that's the key and critical number for it to close above as it did yesterday. If we can see that trend continue, in other words, the market recoup tomorrow, I would look at the next level of resistance to be this top here, and that is at $25 per ounce. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.